Today's topic is continuing chapter 1 with learning objective 3 and learning objective 4. And it's going to cover the three main types of business activity and financial statements of a business. All businesses are typically involved in three types of activities: financing, investing, and operating. Each of these activities can result in inflows of cash or outflows of cash. We're going to look at financing activities first. And typically, when a business is created, it needs capital, it needs money for that. There are two ways of raising outside funds for corporations. One is by issuing or selling shares, which is part of equity financing, and the other way is borrowing money, which is classified as debt for the business. Both activities will classify as financing activities. The second type of activities, the investing activities for a company, will involve the purchase of long-lived assets that a company needs in order to operate. Assets are resources that a company owns or controls. Every asset is capable of providing future economic benefits that can be short or long-lived. Such assets can be classified as property, plant, and equipment, goodwill, intangible assets, or any other assets. A second type of investing activity would be investing activities related to the purchase or sale of shares or debt securities of other companies. These investments may be related to generating returns in short-term or maybe long-term strategic investments that enable the company to have a degree of control or influence over the other company. The last type of activity are the operating activities. Once a business has raised the necessary funds and invested in the long-term assets, it needs to get started. It can begin its operations. The operations would be different based on if the company will provide a service, which is going to be in the service industry, or it will manufacture a product and deliver a product to the customers. And in this case scenario, it's going to be classified as a manufacturing business. Before we're going to look at the financial statements and we're going to analyze the content of each financial statement, I would like to introduce a basic accounting equation, which is the following: assets equals liabilities plus shareholders' equity. Assets would be resources owned by a business, as introduced earlier. Liabilities will be the obligations of a business, money that the business owes to external parties such as creditors. And in the shareholders' equity section, we're gonna have, if it is a corporation, a share capital, which is the primary ownership interest in a corporation, and the retained earnings, which are accumulated earnings of a corporation that were chosen not to be distributed to the shareholders. As we start looking at the financial statements, the first one that we're going to look at is the income statement. An income statement will report revenues and expenses showing how a company's operation performed during a period of time. Revenues will arise from selling a product or a service, and will be a result of an inflow of assets. Expenses will be the cost of the assets consumed or services used to generate revenues. The income statement will report a net profit if the revenues will exceed the expenses, or will report a net loss if the expenses will exceed the revenues. As an example here, there is a net profit calculated based on revenues less expenses. The next financial statement is statement of changes in equity, which will show the changes in each component of shareholders' equity, including common shares and retained earnings, as well as the total equity during a period of time. As we progress to the third financial statement, statement of financial position, we'll present a picture of what the company owns, its assets, what it owes, its liabilities, and the resulting difference, its shareholders' equity, at a specific point in time. This statement is also known as a balance sheet. The fourth financial statement, statement of cash flow, shows where a company obtained cash during a period of time and how the cash was used. Also, additional information will be reported in the notes to financial statements that are cross-referenced to these four statements. The order of preparing those statements is in the order as we looked at. First is the income statement, second is the statement of changes in equity, third is the statement of financial position, and lastly will be statement of cash flow. The reason why if there is such order is because the financial statements are linked between them, and information from one financial statement will be used in the next one.